Ever wonder how the wealthy keep getting richer? It's not just luck, it's strategy. In this video, we're breaking down how rich people invest differently, revealing the smart money moves and mindset shifts that set them apart. Before we dive in, make sure to like, subscribe, and hit the notification bell so you never miss out on tips that help you grow your wealth and think like the pros. Let's unlock some secrets. They invest in assets, not liabilities. While many average investors tend to chase after what's currently popular, like trending stocks, the latest tech companies, or volatile cryptocurrencies, the wealthy take a very different approach. Instead of gambling on quick gains or market hype, rich individuals focus on building portfolios filled with income-producing assets that generate money passively and consistently over time. At the core of this strategy is a deep understanding of the difference between assets and liabilities. Simply put, assets are things that put money into your pocket every month, like rental income, dividends, royalties, or business profits. Liabilities, on the other hand, take money out of your pocket, like car payments, expensive mortgages, or any purchase that requires constant upkeep without generating returns. Wealthy people focus on acquiring real estate that produces rental income, dividend-paying stocks that provide quarterly or monthly cash, private businesses or partnerships that generate steady profits, and even intellectual property such as books, patents, or music that continue to earn royalties long after the work is done. Interestingly, the rich also tend to view their primary residence differently than most people. While many middle-class families consider their home an investment, the wealthy often see it simply as a place to live, not a vehicle for wealth generation. Instead of upgrading to larger and more luxurious homes that increase their monthly expenses, they choose to invest in real estate that pays them. For example, they may own apartment buildings, commercial spaces, or vacation rentals that produce steady monthly income. This mindset shift is critical for long-term financial success. Wealthy individuals ask smarter questions before making investment decisions. When looking at a stock, they often ask, "Will this pay me dividends regularly?" When analyzing a real estate opportunity, they prioritize cash flow, the net income it produces each month, rather than relying purely on appreciation or future resale value. In short, wealthy investors focus on building streams of predictable income. They know that steady cash flow is more reliable and sustainable than hoping for market booms or price spikes. It's not just about getting rich quickly. It's about staying rich by owning assets that continue to pay regardless of market conditions. They use other people's money. Leverage is the wealthy's secret weapon. While most people save up to buy investments with cash, rich people use debt strategically to amplify their returns. They understand good debt versus bad debt. Good debt helps you acquire appreciating assets, while bad debt finances depreciating items. Real estate investors use mortgages to control properties worth millions with relatively small down payments. If a property appreciates 5%, but they only put down 20%, their actual return on invested capital is 25%. They're making money on the bank's money, not just their own. Business owners use credit lines to expand operations, knowing that the returns from growth will exceed the cost of borrowing. They negotiate favorable terms and use their good credit and track record to access capital at low rates. The key is ensuring the investment returns more than the borrowing costs. They diversify across asset classes. Wealthy investors don't put all their eggs in one basket, but their diversification goes far beyond just buying different stocks. They spread investments across multiple asset classes: stocks, bonds, real estate, commodities, private equity, hedge funds, and alternative investments like art or collectibles. This isn't random diversification. Each asset class serves a specific purpose in their portfolio. Stocks provide growth potential, bonds offer stability and income, real estate hedges against inflation, commodities protect against economic uncertainty, and alternative investments can provide uncorrelated returns. They also diversify geographically, investing in both domestic and international markets. When one country's economy struggles, investments in other regions can balance the portfolio. Currency diversification protects against domestic currency devaluation. They think long-term and compound wealth. While most people chase quick gains, wealthy investors play the long game. They understand that compound interest is the eighth wonder of the world, and time is their greatest asset. Instead of trying to time the market, they time their life in the market. Warren Buffett's wealth didn't explode until his later years because compound growth accelerates over time. The wealthy start investing early and consistently, allowing their money to work for decades. They reinvest dividends, capital gains, and rental income to purchase more income-producing assets. They also plan for generations, not just their lifetime. Wealthy families establish trust, teach their children about money management, and build generational wealth that lasts beyond their own lives. They think in decades and centuries, not months and years. They invest in education and networks. Rich people understand that their most valuable investment is often in themselves and their network. They continuously educate themselves about markets, economics, and new investment opportunities. They hire coaches, attend seminars, read extensively, and stay informed about global trends. More importantly, they invest heavily in building relationships with other successful investors, entrepreneurs, and industry experts. Many of the best investment opportunities never reach the public market. They're shared within exclusive networks of high net worth individuals. Wealthy investors join investment clubs, attend exclusive conferences, and build relationships with fund managers, real estate syndicators, and private equity firms. These connections provide access to deals that average investors never see, often with better terms and higher potential returns. They create multiple income streams. Instead of relying on a single job or investment, wealthy people build multiple streams of income. They understand that diversifying income sources provides security and accelerates wealth building. If one stream dries up, others continue flowing. These might include salary from a business they own, rental income from properties, dividends from stock portfolios, royalties from intellectual property, interest from private lending, and profits from various business ventures. Each stream requires initial effort to establish, but eventually generates passive income. The goal is to reach a point where passive income exceeds living expenses. Once achieved, they can take bigger risks with new ventures because their basic needs are covered by existing income streams. This financial freedom allows for more aggressive wealth-building strategies. They control their investments. Wealthy investors tend to approach investing very differently than the average person. One of the key differences is that they prefer to invest in opportunities where they can exercise some degree of control, influence, or insider knowledge, rather than simply handing over their money to a mutual fund and hoping for favorable market trends. Affluent individuals are far more strategic and hands-on in their approach. For instance, many of them invest in businesses, either by starting their own ventures or by acquiring existing companies. This is because business ownership offers one of the most powerful pathways to build and grow wealth. As business owners, they are in the driver's seat. They get to make critical decisions regarding how the company operates, how revenue is generated, how costs are managed, and what long-term strategies are pursued. This control allows them to directly influence the financial outcomes, rather than leaving everything to chance or market conditions. Moreover, owning a business provides significant tax advantages. The wealthy can often deduct a wide variety of business expenses and reinvest profits in ways that significantly reduce their tax burden, options that regular employees simply don't have access to. When it comes to other asset classes, such as real estate, wealthy investors again gravitate toward properties they can add value to through renovations, better management, or strategic development. They don't just buy properties for appreciation. They look for ways to actively enhance returns. Even in investments that appear more passive, such as mutual funds or stock portfolios, wealthy individuals tend to favor those that are actively managed by professionals they know and trust, fund managers with a track record of delivering consistent results. Alternatively, many take the time to become well-informed themselves, learning about specific industries, markets, or companies so they can make smart decisions independently. Above all, they follow a strict rule. They never invest in anything they don't fully understand. This mindset helps them avoid emotional decisions, prevent major losses, and stay focused on long-term wealth-building strategies. That's a wrap on how rich people invest differently. And now, you've got a glimpse into their playbook. You don't need millions to start, just the right mindset and a smart plan. If this gave you a fresh perspective, give it a thumbs up and share your thoughts or questions in the comments. And don't forget to subscribe and ring the bell for more powerful money insights. See you in the next one.